A splendid evening it is to you viewers. Welcome to Equity News on Equity Access, your aerial perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from Hampton Studios in Harare. I'm Ibn Mabunda. Let's get started. Now we'll start by having a look at what took place during the course of the week, just the highlights, and then we get into what took place during the course of the day. Now on Monday, private sector bemoaned abrupt economic policy formulation as well as implementation by government while clamoring for involvement of the private sector in policy formulation. Also on the same day, RBZ Chief Dr. John Mangunjika highlights that $664 million has exchanged hands on the interbank market system. On Tuesday, the Minister of Finance, Professor Mthuli Ncube, makes an announcement that there is an interim budget that is coming on the 31st of July. Hints that there will be a reduction of the tax burden on the part of local citizens. On Wednesday, Zimbabwe's trade deficit narrows 33% in the month of May against the prior month's performance of $140 million in a deficit position. Thursday, Net1 releases 2018 financial results, posting a profit of $10 million against the prior performance of a loss of $77 million. Also, African Development Bank says Zimbabwe needs an infrastructure investment of about $34 billion spread between now and 2030. Now, on to Friday's happenings. Portra's report reveals a 6% decline in active mobile subscriptions to 12.1 million subscribers, with 70% of the market share being held by Econet. The decreased demand is reflective of the depressed demand in the economy and a decline in multi-SIM usage. Meanwhile, revenue earned by internet access providers scaled 6.7%, with Liquid Telecoms accounting for 55% of that market share. At the end of 2018, Econet sold off of its 51% stake in Liquid Telecoms in Zimbabwe in return for a $135 million worth of shares in Liquid Telecoms Holdings, which owns 49% stake of Liquid Telecom Zimbabwe. Now let's just have a deep dive into the stats that have just been released by Portraz. This of course would be the IAP market share. This in here would be the last quarter of 2018, the outer sector there being the performance within the first quarter of 2019. It is interesting to note that for Liquid Telecoms, they've actually re-registered a decline from 59% to 55%, while for Net1 there's actually been the reverse, an increase from 25% to 28%, which suggests that Net1 has actually eaten into the market share that Liquid Telecoms has enjoyed lately. Of note is the fact that as well there's actually been a trade-off there where Dande Mutande is concerned. Dande Mutande gaining from 4% to register a figure of 6%. Now, as we make progress to look at the mobile money subscriptions, not much of a transition with regards to EcoCash. Well, of course, there has been that decline from 95.4% to 94.5%. And again, the winner there being One Money, slightly inching forward from 3.8% to 4.7%. So it appears that in both matrices, there's actually been a positive performance where Net1 is concerned with, of course, their mobile money facility in that regard. Tobacco selling season almost coming to a close. Volumes have been picking up, coming 4% shy of last year's historic performance. And at this point, we are talking about 224 million kilograms. However, value is worryingly down by 36%. Price per kilogram is 33% down at $1.95 per kilogram against last year's performance of $2.92. Again, for perspective, we take a dive into the stats there to look at how things have actually progressed right up to this point. Now, on the auction floors, this is what we've reported, which is 29 million kilograms there, value $52 million. Now, we make a comparison here of 2018 against 2019, and there's indicated the average price per kilo at $1.95 in 2019 against $2.92 in 2018. That's a 33% difference. Now, as I said, in terms of the values there in 2018, at this point, with the value of with the volume that you actually have, we had $680 million worth in terms of the value, but now we are at $436 million, a bit of a worrying figure where that is concerned there. Now we look at the total auction versus the total contract. Total contract standing at 194 million kilograms, while the total auction stands at 29.7 million kilograms. Now leading there is of course TSF at 19 million kilograms, while PTFs come second at 5.3 million kilograms, while Walker lags behind at 4.6 million kilograms in that regard. Of interest would be the fact that tobacco is Zimbabwe's second largest forex earner, raking in just below $1 billion in 2018. And now it seems as though we might be able to hit last year's historic volumes at 253, and now we're just at about $224 million as we near the closure of the tobacco auction selling season in that particular sphere. Now, the National Employment Council for Zimbabwe, where agriculture is concerned, has increased the wages of its constituents by 44%. This, of course, is in the face of get away inflation, which currently comes in at beyond 90%. As we make progress, this concludes our evening news bulletin. Up next is a look at the news in News Review. Please stay tuned.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe, with a complete range of activities, including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures, just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success. Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe, with a complete range of activities, including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success.
Welcome back, viewers. It's now time for News Review, and with me in set is Chief Analyst Respect Gwenzi. Respect, good evening and welcome to the show.
It's always my pleasure. Thank you, Eben.
Beautiful. Let's get the ball rolling. We'll first of all have a look at Portra's report registering a 6% growth in revenue where IAPs are concerned. How important is this growth that has actually been reported there?
I think the key aspect there when you're looking at internet access providers is the issue to do with growth in investment that has happened over the past few years. It has also been in line with the growth in consumption, data consumption across the market. Internet penetration ratios have been going up over the past few years, and I'm sure the latest Portras report shows a growth in numbers in that respect, and also even numbers from other players such as though the MNOs are also realizing a quicker growth in data consumption. So IAPs are obviously leveraging on that expanded base in terms of Zimbabweans who are consuming more data from them. So there's been a growth, and that growth path is likely to continue into the foreseeable future.
I realize now, yesterday I reported on Net1's performance, but we didn't get the chance to actually get into the tinsirinsies. But just looking at what we are actually seeing on this chart, there's been a decline in IAP market share on the part of Liquid Telecoms, shedding, moving from 59% to 55%, while it's a different case for Tel1, which has actually gained from 25% to 28%. And then also, if you get into mobile money subscription, you realize that where One Money is concerned, we've actually registered a growth from 3.8% to 4.7%, while there's actually been a similar margin decline in reverse where EcoCash is actually concerned. What is your perspective where that is concerned?
So with regards to on the IAP side, when you're looking at Tel1 services and you're also comparing them with Liquid, it's about the funding structure. If you look at Tel1, they are supported by Huawei, and Huawei has been offering much of the infrastructure on a loan basis. But now Liquid Telecoms had to be sponsored through capital that is raised from, using internal resources. That is before Liquid Telecoms Zimbabwe was sold to Oro. There was an exchange of shareholding. The shareholding that was held by Econet, which was 51% of the local unit, to the London-based Liquid Telecoms Global. But the funding structure was such that expansion of the local infrastructure had to be done using locally generated resources. And the issue over the past 2 years has been that Zimbabwe has not been able to unlock much of the forex in question. I think that was one of the rationale why Econet had to obviously sell off or exchange its shareholding in Liquid Telecoms Zimbabwe for a 10% shareholding in the global Liquid Telecoms Global. So I think that's what informs the disparity or the gain in market share by Tel1, which has been funded by an external player who is quite liquid. But I think looking more on the MNO side, which is the one that compares the key players, Net1 and Econet, this has mainly been an issue to do with some cheaper packages that were on offer, especially by Net1, and this has resulted in an alternate movement in terms of consumers trying to bargain and downtrade. So I think that is what has informed much of those disparities.
I realize. Now let's get into the tobacco figures. I mean, starting off the selling season, the figures were pretty low, but now we're just 4% shy of last year's performance. Last week Friday we spoke about how we were 5% shy, and now we are 4% shy. There is a chance or a possibility of us maybe reaching last year's historic high of 253 million kilograms. What is your assessment of the situation developing there?
I'm not as much surprised in terms of those numbers, especially in terms of volumes. If you're looking at land underutilization figures as of last year, like the current season, over the current season, you're given the next season's area under plantation. And what I have seen is that there's been a quicker growth year on year. And yet last year we realized the record volumes performance from tobacco. So getting into 2019, I was quite sure that we might actually break beyond the prior year levels. But the key challenge there was the weather, high drought levels, and therefore that obviously had a dampening effect, especially on the quality of output. So what happened in the current selling season was such that when the season opened, players were withholding their leaf in anticipation of firming prices, but that wasn't so. As we saw the dynamics playing out, the weakening of prices as the season progressed, and now we are nearing the end, and therefore there's now a higher uptake or a higher participation of especially individuals in the market. It's now clear that the season is about to end, and therefore you can no longer keep on holding on to your leaf, expecting that prices might actually firm. So getting into the few last days of the season, we are now realizing that there's now a quicker volumes growth compared to last year, and that's closing in the gap that was there in the formative periods of the current season. But in terms of value, it's a pity we are sitting at about 33% below last year, but that does not really inform what Zimbabwe gets in terms of its global sales, because this is what farmers are getting locally, but then buyers would then have to sell in international markets, and they have a right to bargain. Therefore, what they then sell is what Zimbabwe will record as its net earnings from tobacco exports. So that figure, of course, it might come in lower than last year, but that margin of 33% is quite worse off. I think the figures there we're sitting at around 650 million in terms of our tobacco exports, and if we go down by about 25% thereabout, it means it's also reducing our net export earnings from that respective crop. So that's really a big concern for Zimbabwe, and obviously the disruptions around monetary issues in Zim, they are also going to affect how participation in the coming season is.
Participation, I'm very much concerned. I mean, the price per kilo for this year has been 33% below that of last year, and would that perhaps not have a dampening effect in terms of the participation by farmers into the next agricultural season? I mean, we've got a widening trade deficit coming from $1.7 billion in 2017-2018, widening and ballooning to $2.5 billion. What could we expect going forward? Would this not perhaps be of a dampening effect, as I just mentioned, considering the fact that this is actually our second largest forex earner? Your perspective?
Obviously, it's likely to be so, but if you look at the dynamics around tobacco is such that 85% comes from contract farmers, and contract farmers are pre-funded by some of the guys who participate in the value chain. So if we are saying that much or 85% is pre-funded by third parties, it simply means there's no much risk that's carried by the farmer himself, and therefore there's no need really to cut back on production, because the prices are locked and also the inputs, you don't have to sweat to get them. But for individual farmers, looking at how prices have risen over the past few months, it obviously one has to reevaluate the viability of keeping on producing that crop into the next season, given that also prices are not coming in as firm. It means your margins are coming off, or that you're actually selling at a loss. And even if you look at the amount of rejected bells in the current season, they have really been they've really been up. Of course, it might not seem to be a very significant margin, but I think it's really something of concern as well. So there's that risk, and obviously that disincentivizes farmers to keep on producing at the same rate as last year. But we're quite cushioned. 85% of the market is safe.
And then lastly, during the course of the week, we reported on how there is an interim budget that is being rolled out by the finance minister on the 31st of July. What can we look forward to?
There's going to be a revision in terms of both the earnings and also the expenditure side. In terms of the expected revenues, they will now be revised from about 6 billion to something close to 9 billion. But in terms of expenditure, we're going up by about 4 billion from 8 billion. So the initial budget as at last year, the November budget for 2019, it was presented last year in November. We had budgeted that we'll spend about 8 billion, and we had also budgeted that our deficit will be somewhat between 1 billion to 1.5 billion thereabout. But the new figures, as will be presented in the coming weeks, will show a variance in terms of the deficit position of about 2.8 billion. But I think, in my own view, that's quite conservative given the pressures that are coming into. As we get into the second half of the year, we have seen civil service wages being adjusted. Of course, the current figures that were proffered, they're quite meager, and obviously those will be, there will be some revisions to that. But there are also issues to do with some government's participation in terms of subsidizing the market. If you look at fuel, for example, it's currently selling at about 5. Over the past few weeks, the exchange rate has moved to an average of about 9 times local money to the dollar, and yet when the fuel price was set, the exchange rate was somewhat at 6. So there's somebody who was paying the subsidy in terms of the difference between the market rate and the obtaining prices in the market. So obviously government was paying that money, and that's a subsidy which is not readily communicated to the market in actual sense, to say we are subsidizing the importation of fuel. But it always happens when government tries to stabilize the market. So that is part of where the pressure getting into the second half is coming from. The 38.5% subsidy on farmers, that one is a given, and that's over $1 billion in terms of subsidy. And when you're looking at infrastructure, government is pinning its hopes on trying to move some infrastructure deals, much of them stalled in the first half because they couldn't meet the obligations in terms of financing them as they had budgeted in the prior year. So now that there's going to be a revision, obviously they're going to spend something again close to, they're going to add more, about $1 billion more to what they had budgeted initially. So that is what will obviously feed into the budget deficit position. So my own thinking is that we will incur budget deficit of close to 4 billion or even more. Okay. The minister's position is that the budget deficit position will come in at 2.8 billion. They think it's a fair position. Why? Because the key metric in economics, when you're trying to look at stability on the fiscal side, is when you're trying to say what is the deficit position against your GDP position. And the impact of de-dollarizing like we did was to actually it multiplies the GDP position by a certain factor. But what government simply did was to say in 2018 we had 24 billion in terms of GDP.
Yes.
In USD terms. Now that the exchange rate is at Feb or March, when we liberalized, the exchange rate was around 2.53 thereabout. As they simply multiplied the GDP multiplied by the exchange rate then. So it actually pushed the GDP in Zim dollar terms to 70 billion actually. Now, when you're then comparing what you're going to incur as a deficit at about 2.8 billion against a higher GDP of 70 billion, it gives you a ratio which is quite small. So the target was to achieve a ratio or GDP, debt to GDP ratio of about 5%, coming in from about 15%, which was believed to be unsustainable. So they're quite comfortable with the resultant figures out of that whole misrepresented GDP figure, which is now at 70. So I think that's one of the challenges. What it means in essence is that we'll keep on borrowing, and that's the biggest issue with a fiscal deficit. Once you create a fiscal deficit, it needs to be funded, and funding will only come from borrowings from the private sector. And when you borrow from the private sector, you're driving money supply up. And when money supply goes up, there is a disproportionate representation between the local money in the system and the US dollar in the system. And therefore, it widens the exchange rate eventually. And that means more inflationary pressure on the economy. So that's one of the biggest fears that we have, that we might see a recurring cycle of further inflation growth coming if government doesn't rein in on its expenditure, or if it doesn't contain its second or mid-term budget.
Well, thank you for the elaborate perspective there. It would be interesting to see how the story actually develops. Thank you, viewers, for staying with us. Up next is a look at the stock markets in Market Daily. Don't go anywhere.
Good evening, ladies and gentlemen. Welcome to Markets Daily on Equity Access. My name is Anis Chimbumu, your host, and joining me today is Respect Gwenzi, the Chief Analyst. Respect, how are you doing today?
I'm doing good, and you, Anis?
I'm all right.
Sure.
Now, quickly, as we just get into the markets, it seems as if the market has taken a dip again today. The week has been pretty much characterized by oscillations. Much to do with that, I would like to suggest is probably the way trades were actually moving, because also volumes traded have been tracking that movement as well. Coming up, yesterday did come up about 50%. Today it lit up 49% for it to have about 5 million shares having been traded on the stock exchange today. Now, resultant of that now has caused for the market to be down 0.66% on the top 10 index, while the all share index and the industrial index mimic each other, coming off 0.28% for these two indices to settle at 189.98 points, and the industrial index at 633 0.92 points. Now, on a week-to-date basis, we are now settled pretty much in a very comfortable place. I'd like to suggest, as it is in the positive, 0.68, 0.69, 0.19, and 1.33% ahead from prior week performances. What's your take as to how investors are reacting on the stock market at the current moment? It's been up and down throughout the week.
Yeah, but I think from my own view, the initial reaction to the monetary policy measures that were introduced about a fortnight ago was that there was a panic in the market, and the fact that shares were already trading at huge premiums, it meant that the market had to re-rate in a way. So the panic caused for shares to come down. And that was, we saw the market coming off about 9% in the first week, and then in the second week again, there were declines, of course, averaging about 5% thereabout. So we had now seen 2 weeks of consecutive losses, and now getting into the third week, which is now, we're now realizing a rebound in that respective matrix. But I think what's now beginning to dawn on most of the investors is that as long as the exchange rate is not trending downwards, there is therefore no comfort in overexposing your balances in unhedged positions. Therefore, stocks become the only alternative where you can rather park your money and at least avoid losing value out of these macroeconomic challenges that we're currently facing. So I think that's the perception around investors, to say we were expecting that maybe the exchange rate will stabilize at those rates that were being proffered by the Treasury, that rates of above five times are not sustainable, but we have seen the market move as fast to levels now close to 10, and there seems to still be upward pressure for that for those rates to continue to go up, and that means investors' perception has to retrack the initial position where it was actually a negative perception on on our local money.
Okay, I do agree with you that there still may be some pressure on the forex market. Just to highlight a little bit, because we have noticed in the last couple of sessions that the ask price has been moving quite faster than the bid price. But then now, for me, much to do with what you mentioned earlier on, that since the pronouncement of SI 142, the market hasn't been stable, and we have seen that evidenced by the up and down that we have seen. But now, one of the statements within the SI 142 was a 90-day vesting period. For me, and Old Mutual seems to still be having a very good rally at the current moment. It did come off a couple of sessions in the initial stages.
The sentiment is still the same. So what's happening to Old Mutual is that if the exchange rate is worsening, there is still an incentive to hold your money in counters that are fungible. Whether you're going to hold them for 90 days, but the fact is, after 90 days, you still get your equivalent value in South Africa or in London. That is, so I think there's still a rationale to hold Old Mutual as a speculative counter, despite the fact that you have to hold them you have to hold such a counter for 90 days.
All right. Now, just as I mentioned, week to date, 5-day trend, we are comfortable 0.85% ahead of Monday's opening price of level of 188.37 on the All Share Index. Top 10 Index has shown the greatest strength there, much to do with how we have witnessed its influence in the last couple of sessions. Now, we had about five laggards and 8 risers on the stock exchange today. 22 did exchange hands on the local bourse. Power Speed was the best performing counter of the day, coming up 20% for it to settle at 36 cents, while on the other end of the stick, FML did come off 8.12% for it to settle at 22.05 cents. Simbisa down 4.32%, selling at 105.01 cents. Now, Could you give me a perspective around about Simbisa Day? I'd suspect that earnings should come off. I mean, we are in tough times. Their prices may be fair. I mean, in terms of how things are pretty much priced right now, inflation-wise as well. But expendable incomes have been growing thinner by the day. Where do you think it should take the counter?
As of last year, they did obviously beat expectations. My own take was that they would possibly realize slow down in their earnings, but they did outperform in the key market of Zimbabwe. But I think when you're looking at Simbisa, you have to have an appreciation that it's not just a Zimbabwean company. This is a Pan-African company with operations in at least 13 countries. And of course, about 40 to 50% of the income comes from Zimbabwe, but still they are obviously hedged to some extent. But looking on the local side, I think the issue to do with pricing was quite key in the past 6 months. They moved in fast to try to rate their products, to say if I wouldn't give specific prices per product, but they had that exchange rate kind of pricing mechanism up until the last few days. And when we changed to a de-dollarized economy, they then had to put in pricings which were slightly above the exchange rate or the prevailing, even the black market rate. That obviously hedged the product in a way that people would not rush in to buy, whereas they would fail to restock. And now they have again reduced their prices. But if you do an exchange rate valuation, you would simply see that their products are still quite hedged. But of course, on the demand side, like you've said, affordability is a big issue. Most people are looking inwards. They're no longer as outgoing simply because of affordability concerns, and that might result in a bit of a demand tap off in the next in the next couple of months.
All right, Cassava, Econet and Pro Plastics curved the laggard set, coming off 2.71%, 0.63% and 0.26%, while Mash Holdings did add 18.23%, while as it trailed Power Speed, Sitco did add 6.63%, Old Mutual and Star Africa capped that set of top 5 risers, coming up 3.91% and 0.51%. Now, the top 10, the Forex market, there seems as if we are pretty much in a very stable state at the current moment. Last couple of sessions have shown both the black market and the interbank market showing some sort of stability because of how the black market has been trading just between 9.8 and the rate of 10.1 for more ambitious traders there. But then you would find that the interbank rate has pretty much almost looks very flat. If we have apologies there. If we have a quick look, maybe if we just try and go back to our chat right there, right real quickly. Seems that a technical challenge there. But then what I was just trying to get at is that the interbank market seems to be very much flat throughout the week, trading just between 8.6 and 8.7. It did fully surpass the 8.7 mark yesterday. Today it was trading at about 8.78 there about. While yesterday it did come in at around about 8.72. Do you think that we have somewhat reached a level of understanding between the willing buyer, willing seller there, or it seems as if supply has continued to constrain that the movement of that rate there?
I obviously don't think that the market has stabilized as yet. I still feel that they should be an further upwards momentum. And not to say that it's because our fundamentals are as weak, but the initial reaction of any market which is liberalized is that it has to be volatile and we have to see a sharp rise in the price. My own projection was that the interbank would surpass 10 and even 13 times for the dollar. but sitting at around 9 times, it gets me worried. Why? Because the backlog that was existing in the market in terms of backlog payments, it was in excess of $1 billion. And according to the governor, just as of last week, we were sitting at about 660 in terms of trades between February to date. That still shows that there's still demand. On the demand side, there's still demand that needs to be cleared. Of course, much of the legacy foreign debt is now housed with the RBZ under that new deal. But I still believe that the market still, the shock should still be felt at the current moment. If the rate is stuck at a certain point, it might be an impact of lack of supply, which gets to be worrying then, because I mean, in a more fluid market, those forces should match at a certain level, and there is need for us to clear all this legacy debt before the rate can stabilize. I still feel that even a price of 8 in the midterm, not so much in the midterm, but in the next couple of months, could be overpriced. I feel that the market could even stabilize at rates below 8, but it's a function of also confidence and other factors. If government obviously manipulates money supply, then obviously that's going to have also an impact of pushing the exchange rate in the adverse direction because of excess demand coming from that increase in RTGS money. But all things being equal, there is a fair chance that the rate might stabilize at below 8 times. But at the present moment, I still feel it should go up.
Okay, so basically, by end, do you think that we are going to have a very nice stable rate, or it's going to go?
That could only happen if authorities do not timber around with money supply. If they mop up excess money and if they stick to quite a fair budget with a manageable deficit, and they don't they don't print more money. Of course, they're about to introduce 400 more million in real paper notes. But beyond that level, I think if they don't manipulate money supply, there's a fair chance that we might get there. But I think it's wiser to look at the implication of this whole dynamics of electricity, looking at some other energy, fuel and so forth. These are having a detrimental effect on production across the productive sector. And by implication, it also lowers our GDP. And when GDP is low, it means government's taxes also get to be low. So in the second half period, it's likely that we might significantly underperform, and that will impact on government's own net revenues. When you're looking at demand as well, so production is no longer at the same level as last year, and so to even project that revenues might go up by a very significant margin, bad inflationary effect, it might not be a very fair analysis. So there are a whole lot of matrices that are beyond my control or beyond my what I could assume, because government's behavior has been known over the years to be erratic. I mean, I can't put all my money on that.
Okay, thank you, Respect. Well, will the government really hold fast to what they are trying to do, or will they change back to their old ways? It is sure that if a hyena gets really muddy, you can mistake it for a dog, but then if it laughs, you will never forget. Do not forget to like, follow, subscribe, and visit our website, www.equityaccess.net, and our handles are @equityaccess. Good evening.